Chapter. We're talking real money.
It's the Friday Q&A show. Hello, everybody. Don McDonald here on my own today because finally I got enough questions recorded at TalkingRealMoney.com to do an episode. You see, I can't do a Friday episode unless you guys actually record questions at TalkingRealMoney.com. You just go to TalkingRealMoney.com, you click the contact form or contact us, and on there is a little microphone, and you can record your question there on your computer or your phone or your pad or whatever you got. It works. And today's phones, I mean, my gosh, they have the new iPhones have like studio quality mics practically. So you sound really good if you do that most of the time. So please do that. Please do that. The other thing you can do if you want to talk to us is call on Saturdays when we do our live show. We do one every Saturday. We're not even taking off for the holidays. We're going to be there doing shows on Saturdays at 855-935-TALK, 855-935-8255. And you do that between 3 and 5 Eastern time. But today we have questions from people, and let's start with the very first one of those, this one right here, that right there.
Hi, Tom and Don. My question today is about the pros and cons of investing in a bond fund as opposed to buying individual bonds and holding them until maturity. I retired last year at the end of 2024. I had, at that time, a target date fund for 2025 through my previous employer. And as we approached 2025, the fund had shifted, of course, a higher percentage to bonds, which is logical. However, the fund was doing really badly. And I was told the problem was that people were panicking over how poorly bonds were doing at the time. So they were selling their shares in the bond fund. And of course, as a result, the fund then had to turn around and sell some of its underlying bonds in order to give cash back to the investors who were selling, which in turn led to a lower price for the fund. My question then is this. I've heard that a bond fund is riskier than holding individual bonds, of course, good quality bonds, of course, because there's another factor now to consider. People are people and may start selling their shares before the maturity date of the bonds if they think the market is bad or if they panic for any other reason, as people tend to do. You guys have mentioned this several times, right? What can you tell me about this idea that bond funds have this particular disadvantage? All ears here. I'd love to know what you guys are thinking about this. Thanks so much for everything you do for the community. I look forward to your answer.
It's curious that you brought this up because there was a recent article in Barron's about the 3 myths about bonds, and this was one of the myths, that bond funds are riskier than individual bonds. In a certain way, the perception of risk is greater, and it's related to what you mentioned. However, most bond funds are of such huge size that they can withstand a great deal of selling and meet most of that demand for cash from cash that's coming in, from new investors' cash or from bonds that have matured and they've got cash to reinvest. So they can do a lot of it from that. Rarely do they have to go out and sell their longer-term bonds, which they would not do if they had a substantial loss. They would start with their shorter maturity bonds that would have a closer price to the purchase price because they're about to mature. So that's not the reason, but bond values do fluctuate as interest rates change. So if interest rates rise, the value of an existing bond fund is going to fall. If interest rates fall, the value of an existing bond fund is going to rise, generally speaking, because the bond prices are changing. The shorter the maturity of the bond or the bond fund generally, the less volatility you're going to have. So it's really not risk, it's volatility. And that exists the same in bonds or bond funds. The only thing is if you own the individual bond, you can hold it to maturity. The bond funds are going to try to do that with their longer-term bonds. They won't always succeed, but the advantage to having a bond fund is sort of the advantage to having a bond ladder. And that is, as rates move, you invest at the prevailing rate with new money coming in. So if rates have risen, even though the value of the fund has gone down, you have the possibility, in fact, the probability that the interest rate is going to rise as they go into new longer-term bonds with higher rates. So I think that eliminates a lot of that concern, and that's why I use both bond funds and a CD ladder in my personal portfolio. I have a whole bunch of BND and then a bunch of CDs from 1 to 5 years. I think it gives me the best of both worlds, but I wouldn't have a problem just owning BND either because it's such a huge fund. It's got so much diversification, so many assets that it is not going to take big hits because people are selling. They've got enough liquidity to handle that. It's just going to take the hit from the market value of the bonds as they have to be marked to the market as their value changes. So thanks for the question. I hope that answered that. And let's go to the next one.
Hi, Don. Hi, Tom. This is TJ calling from New York. We got a general question. My son is 17, worked this summer, and we are going to start a custodial Roth IRA through Vanguard. Generally, the target is a good idea just to get started, but we're wondering if we didn't go the target and we were looking for more of the ETF style. If you have any suggestions within the Schwab, what would be a good starting point for my son with a little bit of growth, value, and some international, if you have any suggestions. Thanks so much.
Now, you see how good that mic sounds? Listen to those birds. Really incredible. Good for you guys. Starting a Roth IRA at 17. Now, you mentioned both Vanguard and Schwab in there, so I'm going to do a Vanguard Schwabi answer. If you really want a great diversified portfolio, I probably wouldn't start with a target fund. If it's at Vanguard, I'd probably use VT and VBR, which is the small cap. So you're going to get U.S., international, and you're going to get some small cap value. Those would be, I think, great. And you could be, when you're 17, you could even be heavy in the small cap value fund. If you're going to Schwab, the simplest thing to do is just AVGE, which gives you a small value tilt and the whole world all in one ETF. So I think that those would both be good choices. And I think if he keeps doing this for the rest of his life, he won't have to worry at all about retirement. He'll retire massively comfortably. Thanks for calling. We appreciate it. Now to the next one that came in from TalkingRealMoney.com.
Hey guys, love the show. Thank you for what you do to educate. I'm 49. My wife is 48. We've set a retirement date, at least from the day-to-day grind, 2.5 years from now. We have approximately 4.2 million saved. That is roughly 1/3 brokerage, 1/3 Roth, and 1/3 traditional. Included in my brokerage number is $125,000 in I bonds and $50,000 in treasuries. Here's my question. Right now we have an 80-20 portfolio, but the majority of our bond holdings are in our traditional accounts. I'd like to build a 3 to 4 year bond hedge in our taxable account, which would be approximately $400,000. Even though the interest rate is down, I still like I bonds for their tax deferral, but we're limited to $20,000 per year. What are the best bond or bond type holdings to have in a taxable account that minimizes current interest payments? We have a combined marginal tax rate of 26%. Any insight you can give is appreciated, and thank you again for what you do.
Thank you for listening and for the question. You are at the point in life where it probably makes sense. If you're in the 26% marginal bracket, it does make sense for you to look at a tax-free bond fund. And probably the best bet for you is the equivalent of BND, the total bond market index, which is the tax-exempt bond ETF. The symbol is VTEB. And VTEB is yielding, on an after-tax basis, about 1/4% more on an after-tax basis than the BND fund, the total bond index. So you're going to get a little advantage there, and you probably want to keep that advantage for the next 5 years until you're ready to do the beginnings of retirement. And then look at your tax situation then. You may continue to be in a high bracket given how much you're saving. So if you're looking for bonds, I would probably go with the tax-exempt fund this time and get that great diversification and get it in the form of the ETF, because there are, from time to time, capital gains distributed by funds as they sell bonds for whatever reason, to pay off distributions, whatever it might be. So the ETF will not distribute capital gains, whereas the fund could. That's the way I'd go. Thank you so much for the question and the call, and I wish you well. You've done very well. You've saved incredibly well. And now, our final question of the day.
Hello, Tom and Don. Love your show and listen to every podcast. I am 73, retired, and have started my RMDs. Everyone says you should rebalance yearly. 95% of my IRA has bonds in it, and I have a sizable brokerage account composed of all stock ETFs. My total portfolio, including the personal brokerage and IRA, consists of $8 million, which is composed of 65% stock and 35% bonds. My question is, if I sell bonds from my IRA, then my stock bond ratio will not be correct. In order to rebalance, I will be forced to sell my winners in the personal brokerage account and buy bonds to rebalance. This will incur some fairly large long-term capital gains from my personal brokerage account. What do you recommend that I should do in this situation?
This is exactly why rebalancing must be disciplined, scheduled, rote. You have to do it at the same time, all the time. Otherwise, you start looking at it and going, well, maybe I'll just wait a little while because I have all these capital gains and I don't want to pay taxes on them. And this problem is particularly prevalent this year. I just went through it, where I had to sell some of my equity ETFs in my regular brokerage account to rebalance, and now I'm going to pay capital gains taxes next year. But I'm of an age where rebalancing is even more important because I don't want too much risk in the portfolio. I don't want to be overweighted in equities when a bad market hits, which might happen. Well, will happen someday. So I want to be properly balanced. I want to have the right mix of U.S. and international and the small and the value and the equities and the bonds. But I do it at the end of the year. Do you know why I do it at the end of the year? For situations just like this. I'm not particular about the date. I just do it in the last couple of weeks, actually in December. I try to just pick a time in December and do it. If I had to sell more, if my gain was going to really be a problem, what I would have done is sold a portion of what I needed to sell for this year in 2024. And then come January, I would have sold another portion to cover the rest of the needed position that I was selling so that the tax implications hit me the following year. In hopes that, next year, maybe I don't have as big a gain. Well, not in hopes. Of course, I hope I have a big gain, but just in case I don't. If I don't have a big gain at the end of 2025, then I spread that tax hit out. And in many cases, I'd keep myself out of a higher bracket. So I think that's probably what you should look at. You should do a little tax planning, but do your rebalancing at the end of the year. And if it looks like it's going to be too much, it's going to kick you into a higher bracket, then just put a little bit off until 2025, but do it right at the beginning of 2025 in that first week of the new year. And then it's a little less painful, but it has to be done. Rebalancing has to be done because the pain of having too much in equities when we get hit with those 2008 50% kind of drops is too great for those of us who are, heading into retirement or in there. Thanks so much for your call and your question. Thank you all for them. And remember, we take your questions all the time at talkingrealmoney.com. Just hit the Contact Us button in the upper right. You can type your question or you can speak your question. And I love it when you speak them because then I do them on the Fridays. And I need some more. I need a bunch. Although we're not going to have 2 Q&A episodes for the next 2 weeks because we have holidays in there and the Saturday show is moved and it'll be a different schedule. And you can also, though, call us live and actually have a conversation with us on Saturday. And we're going to be here through the holidays on Saturday. You can call 855-935-TALK. That's 855-935-8255 every Saturday from 3 p.m. to 5 p.m. Eastern Time, noon to 2 Pacific Time. And I hope you keep listening. But if you don't, I'm going to wish you a Merry Christmas, Happy Holidays. We'll do it again over and over again anyway. So please do that. Call in with your questions. Tell a friend about the podcast. Share it with people over the holidays because it's a good time to tell people about things like this, and it helps build our podcast up. And then join me and Tom almost every day, except for a few holidays, as we do what needs to be done more in this country, and that is talking real money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.